Hi, welcome back. In this session, the sixth update that I have to my 2018 data, I'd like to bring things full circle and talk about the cost of capital. In a sense, the last few sessions have been leading up to this, right? We talked about risk-free rates in the context of currencies, we've talked about risk premiums. Now it's time to come full circle and talk about how these numbers all to come together in the cost of capital. Now, before I go on, if I asked you what the cost of capital for a company is, what's the first thing that comes to mind for you? I would wager for most of you, you're thinking, what does it cost me to raise my capital? What is my cost of funding? And that is unfortunately how we tend to think about cost of capital. You're saying, unfortunately, why? Well, I'll explain in a minute. I call the cost of capital the Swiss Army knife of finance. Why? Because it's everywhere. Think about it. In corporate finance, the cost of capital is both your cost of raising funding for a company and a hurdle rate for the company and its projects. In capital structure, it's an optimizing tool. It's how we decide what the right mix of debt and equity for a company is. In dividend policy, it tells us whether the company should be returning more or less cash. In valuation, it is of course the discount rate and discounted cash flow valuation, but that understates what it really is supposed to do. It is the only place for you to place risk in when you do a valuation. It is your conveyor for risk in a company. So in other words, cost of capital is everywhere, and because it's everywhere, people often mean very different things when they say cost of capital. In fact, as we've gone through time, cost of capital has accumulated all these monikers, other names that make it often difficult to even think about what you're talking about. So here referred to as WACC, my least favorite word for it, a cost of funding, a hurdle rate. So in a sense, often people use cost of capital to mean different things. So let me take you back to that cost of funding assumption that we often use, or definition that we often use to talk about cost of capital and why it's so dangerous. If you think about the cost of capital as the rate at which you raise money, your cost of funding, then you're going to use that as your discount rate on every investment you take. So in a sense, you're saying if my cost of kind of funding is 9%, I need to take 9% on every investment I take. You're saying, what's wrong with that? Well, there's lots of things that can go wrong with that, and let's talk about why. In fact, rather than think of the cost of capital as a cost of raising financing, let me suggest a healthier definition. The cost of capital is the rate of return that an investor can make on an investment of equivalent risk. It, in fact, might coincidentally be your cost of financing, but the better definition is to think of it as an opportunity cost, the rate of return you can make on an investment of equivalent risk. This seems to me a very fundamental, a very logical way to think about cost of capital, because it eliminates a kind of subsidy mistakes that are embedded when you think of the cost of capital as a cost of raising financing. Subsidy mistakes how? You think if you can raise money at a low rate, you can go out and take projects that make more than that rate. Well, if those projects are risky, you're subsidizing the projects. In fact, I would argue that there are manifestations out there of these subsidies, of people misunderstanding what the cost of capital is supposed to measure, and here are four. The first is I am astonished at the number of companies I see, and these are large, supposedly sophisticated companies that are in multiple businesses but happen to have one hurdle rate. How can that be? You're in many different businesses, you have lots of different risks. How do you have one hurdle rate? They give me all kinds of excuses, but from a corporate finance 101 standpoint, that tells me you're missing a very key element of corporate finance. Here's a second and a very common example. In an acquisition, acquiring firm has to value target firm, right? Now to value the target firm, you need a discount rate, a cost of capital. In more than half of all acquisitions, do you know that the acquiring company uses its cost of capital to value the target company? Why? Because it thinks of the cost of capital as a cost of raising financing. They say, look, we raise money at 8%. That's the money we're using to buy the target company. That's what we're going to use as our discount rate. Third, I've heard analysts talk about what a terrible asset cash is. Well, is cash a terrible asset? Well, in one way it is, right? You earn a really low rate of return because in most developed markets, in fact, if you follow IFRS or GAAP, when you say something is in cash and marketable securities, it's invested in something liquid and riskless. So what? It's earning a really low rate of return. In fact, for the last decade, These investments have made less than 1%. You're saying that is terrible. In fact, I've seen analysts compare that rate of return you earn on cash to your cost of capital as a company and say, this is the worst investment you ever made. Why? Because they think the cost of capital is raising funding, and they say, well, if you take that funding and putting it into cash, you're destroying value as a company. That is patently untrue, because cash is a liquid riskless asset, and if you think of the discount rate as what you would make on an investment of equivalent risk, cash is making exactly the return you should make. If you look at target companies, say what's the risk in that target company, and think about discount rates based on that risk, it's a cost of capital of the target company you should be using. If you look at multi-business companies, say what's the cost of capital, it's obviously going to vary across businesses. And finally, you hear people talk about how a company that earns a higher return on capital, ROIC as some consultants like to call it, or a higher return on equity, is a better company than a company that earns a low one. Well, that might or might not be true. It might be true if they're in the same risk. But if they have different levels of risk, you can't make that statement. You have to bring in the cost of capital of the two companies into the mix and look at excess returns to make that judgment. So if you take that perspective of cost of capital, our task is laid out for us. Let's think about the process of estimating cost of capital. I'm going to use one of my favorite devices in corporate finance to introduce this concept, a financial balance sheet. On the asset side of the balance sheet, you see assets in place, investments you've already made as a company, and growth assets. This is the value I'm giving you for investments I expect you to make in the future. So it's a financial balance sheet, not an accounting balance sheet. It allows me to reflect future growth. On the other side of the balance sheet, notice there are only two items. There are only two ways you can fund a business, debt or equity. You can dance around this as much as you want. For a young private business, debt may take the form of bank loans and equity might be your own money. But as you mature as a company, the debt might become bonds, the equity might become stock, but the principle doesn't change. In fact, when you see hybrids, just think, they're just combinations of debt and equity. Ultimately, it's got to be debt and equity. So to estimate cost of capital, our task is framed for us, right? We have to estimate a cost of equity and a cost of debt. Let's take each one. The cost of debt is the rate at which I can borrow money long term today. Long term and today. So it's not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. So it's the rate at which you can borrow money long term today. And if the tax code is tilted in your favor, the cost of debt needs to reflect it. The cost of equity is the rate of return your equity investors need to make. Not even to be happy, just to break even on your stock. So it's going to reflect how much risk they see in your equity and how much compensation they demand for the risk. Let's think about then this process of estimating cost of equity and cost of debt. We've worked for 60 or 70 years in finance trying to find an answer to what's the cost of equity for a company. I won't even claim that we're close to an answer, but we're working our way to an answer, and this is the reasoning we employ. We say the cost of equity, especially if it's a large publicly traded company, has to be seen through the eyes of the marginal investors in the company, investors who own a lot of stock and trade the stock. We make a leap of faith and assume that those investors are diversified and argue that the only risk that they will then see in equity is the risk that they cannot diversify away. And the different risk and return models in finance quarrel about how to estimate that risk you cannot diversify away. With the CAPM, the oldest model in place, that risk is measured with one beta. With multi-factor models, with the arbitrage pricing model, you might have multiple betas, but the principle remains the same, and the process of estimating the cost of equity stays the same. You start with a risk-free rate, and to that you add a risk premium that's a function of two things. What the relative risk of your company is, which is what a beta or betas measure, and what the price of risk is for that risk factor, the market risk factor. In the CAPM, there's only one market risk factor. It's the entire market. It's an equity risk premium and one beta. You get a cost of equity for a company. Now, we could spend the rest of the session arguing about the CAPM and betas. You know what? I'm exhausted with that argument. I'll give in. You don't like the CAPM? Okay, I can live with that. I'll give you an alternative that might make you feel a little better. And this alternative does not require you to assume anything about risk and return models. Let's face it, to develop a risk and return model from scratch, which is what finance people have been trying to do for 50 or 60 years, you have to make assumptions about how investors behave, how risk averse they are. Yeah, and those assumptions are those assumptions going to be unrealistic? Absolutely, and that makes people uncomfortable. So I'm going to suggest a way in which if you do not want to make these assumptions, and you want to be agnostic about risk and return models, you can still estimate a cost of equity. Let the market tell you what the cost of equity is. You say, how would the market tell me? Remember a few sessions ago, I estimated the equity risk premium for the S&P 500. What I did was I took the level of the index and the expected cash flows and backed out from the level of the index what the internal rate of return had to be to get to that level of the index. In other words, I solved, given the price of stocks, what the expected return is. That's for the entire market. Now assume I did this for sectors. I took all banking index and backed out from it an implied equity risk premium for banks. Took the energy index and backed out from it. You could do this. In fact, I'm considering actually adding this on as an additional layer to my implied premiums. What would that tell me? It would tell me on average what the market is demanding as a cost of equity for banks. What goes into it? Hey, it's a market. Who knows what goes into it? Their fears, their hopes, whatever they're worried about is in there. And as a price taker, that could become your cost of equity. So that's your first stop. Let's talk about the cost of debt. Remember how I described it? It's a rate at which you can borrow money long term today. It's not the rate at which you borrowed money 2 years ago, 5 years ago, 10 years ago. It's not your historical cost of debt. And actually, I'm going to argue that the way I've defined it makes your life easier, and here's why. To get the cost of debt for a company, you don't need to know its history. You don't even need to know what's in its books. You just need to start with a risk-free rate and add to it a default spread, where you bring in the credit risk of the company, the chance it will not make its debt payments, and you capture that with a default spread. You, of course, if you get a tax benefit, have to multiply this entire cost of debt by 1 minus the tax rate. Let's take a stop at the default spread. There are 3 ways you can estimate a default spread from easy to difficult. The easiest is when your company has bonds outstanding, long-term bonds. They don't have any special features in them, so you can look up the interest rate in the bond and say, look, why am I looking for trouble? There is my long-term cost of debt. It already has a default spread embedded in it. That's the easiest one. The second, and this is probably where you're going to fall back, because even most companies that have bonds outstanding, those bonds are not liquid and traded. You look up the bond rating for the company. You are assuming the ratings agencies know what they're doing, and that might be a dangerous assumption. But think of the work it saves you. You know your company's BBB rated. You can guess what kind of default spread goes with it, given how other BBB rated bonds trade for. You add that to your risk-free rate, you got your cost of debt. So what if you don't have bonds and you don't have ratings? Remember, 90% of companies around the world borrow from banks. Well, you can act like a ratings agency, estimate a synthetic rating. I actually use one ratio, an interest coverage ratio, to come up with the rating for companies, and that allows me to come up with a default spread and a cost of debt. Now, of course, I have to net out the tax benefit, and for that I need a tax rate. And here, the tax rate I should always use is a marginal tax rate. Why? Because interest saves me taxes at the margin. And that effectively means that when I pay $100 in interest on a $1,000 income, I am saving taxes at the margin. I'm going to use the marginal tax rate. That's my cost of debt and my cost of equity. Final piece of the puzzle, I need weights for both. And let's look at the choices. Should I use market value or book value? Market value, of course, would require market value of equity and hopefully market value of debt. Book value would be shareholders' equity from a balance sheet, an accounting balance sheet, and debt from a balance sheet. To me, the choice is simple. Cost of capital is the cost of raising money in the marketplace today. And I can't raise money at book value. I have to raise money at market value. So it's got to be market value. Market value equity, market value debt. If it's a publicly traded company, market value of equity is going to be easy. Debt might be a little messier. If it's a private company, both numbers might be difficult, but I'm going to argue that even for private businesses, using book value is a recipe for disaster. The second is, should I use the current debt ratio or the target debt ratio? What do I mean by that? If I take the current market value of equity, let's say it's 90, and the current market value of debt is 10, I have a 90-10 mix. I could compute the cost of capital based on that mix. Perhaps the company's told me that they're going to move to a 30% debt ratio over the next 5 years. You're saying, which one should I use? I'll save you the trouble. You can use both. Here's why. Right now, they're at a 10% debt ratio. Why get ahead of yourself? Use that to get your cost of capital started. And over time, if you believe that the company is going to move to the optimal, essentially, or the 30% target, move your debt ratio from 10% to 30%. So it'll be 10, 14, 18, 22, 26, 30, which means that your debt ratio will change over time. Your cost of capital can change over time. You're saying, is that allowed? Absolutely. So that's the cost of capital part. Let me lay out what I did when I estimated cost of capital from other companies in my sample. Let me make some concessions. I have 43,800 plus companies in my sample. There is zero chance that I can pay personal attention to each of the companies. So the choices I made are bludgeons. I am not happy about these choices if I'm looking at an individual company, but across 43,800, it's the best I can do. Let's start with the risk-free rate. I did everything in US dollars to make the cost of capital comparable. This was the least onerous of my assumptions. I used the 10-year T-bond rate as my risk-free rate, 2.41%. Second, I looked at an equity at a beta. And to get a beta for a company, I looked at the primary sector that company was listed in and used the unlevered beta for companies in that sector, estimated globally, and then adjusted that unlevered beta for the debt to equity ratio of the company. And I did include leases as debt when I did this. So it's interest bearing debt and leases. So basically my beta is a levered beta, but it's a beta based upon the sector averages and adjusted for debt and the marginal tax rate of the country the company is in. For the equity risk premium, I used the country in which the company was incorporated, and I stopped there. I know, and we talked about this in the last session, this is sloppy. You're saying, why don't you bring in the mix of countries, companies in? My data, my raw data provider doesn't provide an easy way for me to get to that. And clearly I would do this differently if I were looking at an individual company, but I use the equity risk premium of the country in which a company was incorporated. To get to the cost of debt, I start with the same T-bond rate, but for the default spread, I first checked to see whether you had a rating. And if there was an S&P rating for the company, I used that rating to come up with a default spread. But for most of the companies in my sample, because there was no rating, I used the interest coverage ratio to estimate a rating, the rating to get a cost of debt. I have a cost of debt for every company, a pre-tax cost of debt. I looked up the marginal tax rate by looking at the tax rate of the country in which the company was incorporated. Here again, that's sloppy because, as we know, companies can decide where to place their debt, and if they have enough income in a higher tax locale, they might do it. So I'll admit up front the cost of capital I got were approximation, but they're the best I could do with 43,800 plus companies. Incidentally, if you are interested in computing the cost of capital for an individual company, making better estimates, multiple businesses, multiple countries, there is a spreadsheet attached to this video that you can download and use for an individual company. One final point about cost of capital before I show you what the numbers look like at the start of 2018. The cost of capital is a going concern concept. You're saying, what are you talking about? When I use the cost of capital, I'm assuming my company might have trouble, but it'll keep going and going and going. That it will not go out of business. There is no truncation risk. Or if it's going to liquidate, that it happens at a pre-specified time on its own plan. So I take the expected cash flows over that lifetime and I discount them at the cost of capital. You're saying, so what? If my company has significant truncation risk, like what? It's a young startup which might run out of cash and go out of business. It's a company with a lot of debt that might be unable to make a debt payment and be forced into bankruptcy. Or it might be an emerging market company in a country where governments nationalize companies. That kind of risk I cannot bring into a cost of capital. You say, but I want to affect value. You're right. Your value will be lower in these cases, but the way to do this is not through the discount rate. Use a conventional discount rate to come up with a value for your project or business, and then bring in your truncation risk by estimating a probability of that risk happening and what will happen to your value if it happens. So as an example, if you're worried about nationalization risk, you're going to do a discounted cash flow valuation of your company as if there were no nationalization risk. And then at the end, you're going to ask two questions. What is the probability that I will get nationalized? And how much will I get if I get nationalized? And you're definitely not going to get fair value. It's at expected value that you'll be willing to pay for the company. You ready? Let's start looking at the numbers. Incidentally, when I say look at the numbers, let me explain why I think it's so critical that we get a sense of what the numbers look like. The first is I am befuddled by the rules of thumb that I see out there on cost of capital. I'm not even sure where they come from. I've seen people come up to me and very, very confidently tell me, oh, the cost of capital for a typical company is 10%, right? And I said, where do you hear that? See, I've been using that for 30 years. Second, these rules of thumb, once they enter our minds, start to skew values. What do I mean by that? If you think a reasonable cost of capital is 10%, here's what's going to happen. Let's say you take today's risk-free rate, today's beta, and you plug in the numbers, you end up with a 6.5% cost of capital. You are convinced you missed something, right? So what do? You start adding things. This is my primary argument against using the build-up or the make-up approach of cost of capital, where you keep adding things till you get to a number you wanted to see in the first place. Why bother? So when you look at cost of capital, it's important that you not let your priors drive your estimation process. So let's take a look at what the numbers look like at the start of 2018. Let's start with the US. I'm going to do everything in US dollars. And here's what the numbers look like. My risk-free rate on January 1st, 2008 was the T-bond rate, the 10-year T-bond rate, 2.41%. If you remember, I estimate an equity risk premium for the US of 5.08%. You add those two numbers up, my cost of equity for a typical company is going to be 7.49%. The cost of debt for a typical company at the start of 2018 was about 3.91% pre-tax. And if you factor in the new tax rate that's going to apply for US companies with the tax code, it's 24%. You end up with an after-tax cost of debt that reflects that new tax rate. So here's what my cost of capital would look like if I plug in the numbers today. 7.49% is my cost of equity. 3.91% times 1 minus 0.24 is my after-tax cost of debt. The typical company in the US had about 23.5% debt and 66.5% equity. You plug in that mix, you end up with a cost of capital of 6.43%. Are you shocked? Don't be. Given where rates are today, and given the price of risk in this market, you should expect to see a cost of capital for a typical company of 6.43%. You know why this is useful? You go into a company and they say they're using a 12% cost of capital. You're going to be suspicious, right? This gives you a sense of perspective. It gives you a sense of, hey, that's what a typical company is. So when I use a 9% cost of capital, I'm using a high cost of capital. Let's expand on this. Obviously, the cost of capital is different across sectors. Why are they different across sectors? Because the betas vary across sectors, the debt ratios vary across sectors. At the start of 2008, here's what the cost of capital looked like across sectors in the US. I'm not saying that these are the right numbers, but you can see that there's a variation. Again, it's to get some perspective on what a high sector cost of capital looks like and a low sector cost of capital looks like. Final piece of the puzzle, I took the cost of capital for all 7,400 companies for which I have cost of capital in the US, and I put them on a histogram. Remember histograms from statistics? I just count the number of companies with cost of capital less than 4%, 4 to 5, etc., and I put up the histogram. And if you look at this histogram and you look to the right, you see me break down by deciles the cost of capital for US companies. And it's shockingly low, right? The 90th percentile of cost of capital for a US company at the start of 2018. And this is a public company. It's about 9%. So when you use 11 or 12%, you're way out there. That is a risky company's cost of capital. Now let's turn to global companies. For a typical global company, again, I'm going to do things in US dollars so that you can get some comparison going. It's the same starting risk-free rate because I'm doing things in US dollars, 2.41%. The beta is 1 because I'm looking at a typical company. The equity risk premium, this is the GDP weighted equity risk premium for all of the countries in the globe, is 6.2%. The debt ratio for a typical global company is a little higher. It's about 26.67%. And the cost of debt is a little higher again because there's some country default risk that creeps into companies. Overall, though, the cost of capital for a typical global company is about 7.3% in dollar terms. You see, what if I don't think in dollar terms? What if I think in rupee terms? Easy. Here's all you need to add. Take that 7.3% cost of capital, add the difference in inflation rates between the dollar and the rupee. You have what should be a typical cost of capital for a global company in rupee terms. Now again, looking at sector differences across the globe, at the start of 2008, you can see my estimates of dollar cost of capital by sector for global sectors. Again, I use this to get perspective when I value a company in a sector to see what my company's cost of capital looks like relative to the sector average. Finally, if you look at the global histogram, you see a few more high numbers, but if you look at the 90th percentile again for global companies, you're not looking at 15, 18, or 20%. You're getting a number that's a little less than 11%. Again, this gives us perspective. In the market we're in, with the risk-free rates we have and the price of risk being where it is, cost of capital should be relatively low. So let me close off with a couple of suggestions about the cost of capital. The cost of capital is a number we run into all the time. And I would suggest that the next time you hear somebody give you a cost of capital, that you step back and look at that number and ask, does that number make sense given where numbers lie right now at the start of 2018? So if you get a chance, take a look at your favorite company and estimate the cost of capital for that company. Get your hands around it. It's not a difficult thing to do. This isn't rocket science. Okay? And then think about all of the different places that that cost of capital will get used. Thank you very much for listening.